A powerful market pullback could be on the horizon, whether you're ready or not. And if you're retired or close to it, that pullback could cost you everything or nothing at all. The difference, one critical decision most retirees get wrong. In this video, I'm going to show you exactly what that decision is, why timing the market is a trap, and the surprising data that proves market downturns don't have to destroy your retirement. Now stay with me, because what I'm about to show you might change everything you think you know about market risk. And if you stay with me until the end, I'll show you the exact 3-bucket strategy we use with our clients to protect against sequence of returns risk so you can stop worrying and start living. Before we talk about the next market pullback, let me show you a piece of research that explains why so many retirees feel paralyzed by market volatility. This comes from a Vanguard study called Sequence Matters: Managing Income and Withdrawal Risk in Retirement. They looked at 2 retirees, same $1 million starting balance, same annual withdrawals, same 60-40 portfolio, and the same long-term average return. The only difference? One ran into a pullback early in retirement and the other didn't hit that downturn until 10 years later. Here's what Vanguard found. The retiree who hit the downturn early sees their balance drop sharply and never fully recover. The retiree who gets those bad years later, their portfolio actually grows even though the returns were identical over time. Vanguard's conclusion was crystal clear. It's not the average return that determines retirement success, it's the sequence of returns. Same withdrawals, same plan, same returns, totally different outcomes. If you want to read that study later, the link is in the description. Now here's a question that keeps most retirees up at night. If timing matters this much, should I just get out before the next pullback? Hold that thought. I'm about to show you why that's the exact wrong move. Now, if you're new here, my name is Kurt Supi. I'm a CPA and retirement planner with over 25 years of experience. All right, let's keep going. Take a look at the S&P 500. Since 1980, the market has fallen 10% or more in nearly half of all the years. And the average downturn each year about 14%. So a downturn in retirement isn't optional, it's guaranteed. But here's what most people miss. Since 1928, the S&P 500 has had positive annual returns 74% of the time. Even with pullbacks, even with recessions, even with all the scary headlines. So the question isn't, will there be a pullback? The question is, will you make the right decision when it happens? And that brings me to the challenge every retiree is facing right now. At the time of the recording of this video, it's December 2025, and the market has hit another all-time high. We're looking at 3 consecutive years of double-digit gains. After a run like that, every retiree starts thinking, okay, how long can this actually go on? Historically, when the S&P 500 strung together 3 straight years of double-digit gains, the 4th year was basically a coin flip. Up 5 times, down 4 times. So if you're retired or near retirement, it's natural to wonder, is the next year the one that wipes me out? But before you panic and move everything to cash, let me show you something that might surprise you. Most people think investing at new highs is dangerous. It feels like buying at the top, right? But JP Morgan studied this from 1988 to 2023. They compared investing on a random day versus investing on a day when the market hit a new all-time high. And here's what they found. 6 months out, almost no difference. 1 year out, investing at highs slightly outperformed. 2 years out, the gap widened. 3 years out, 48% of success versus 40%. 5 years out, investing at highs won almost 80% of the time. New highs aren't warnings, they're milestones. Skipping them out of fear can cost you years of growth. But here's where it gets really interesting, and this part changes everything for retirees. What if you could just avoid downturns altogether? Sit on the sidelines when things look shaky and then jump back in when it's safe. So Wells Fargo studied the S&P 500 from 1995 to mid-2025 to answer that exact question. If you stayed fully invested, your return was 8.4% per year, but missed the 10 best days, 5.6%. Missed the 20 best days, 3.7%. Miss 50 days of the best days, you actually end up negative. A handful of days determine the entire outcome. And here's the crazy part. 7 of the 10 best days happened within 2 weeks of the worst days. If you try to dodge the pain, you almost always miss the recovery. That's the trap. That's the critical mistake. And it's exactly why so many retirees underperform, even when they think they're being smart. Now you might be thinking, okay, but what if the pullback lasts for years? Fair question. A CFRA study going back to 1945 found a 5 to 10% drop recovers in 3 months on average. A 10 to 20% correction recovers in 8 months. Most downturns don't drag on for years. Recoveries almost always show up faster than people expect. But even knowing all this data, most investors will get it wrong, and here's why. DALBAR looked back 20 years and found something shocking. The S&P 500 returned about 10% annually. Real estate and international stocks also grew strongly, but the average investor earned less than 1/3 of the S&P 500. Why? Fear. Fear leads to emotional decisions at the worst possible times. Selling lows, sitting out recoveries, missing the best days. This is the critical mistake that drains retirement savings when it doesn't have to. So what's the solution? All right, here's what we actually do with our clients to solve this problem. It's called a reserve strategy, and it's designed to protect you from sequence of returns risk without forcing you to sit in cash and miss out on all the growth. And here's how it works. We bucket your money into 3 parts. Bucket 1, your reserve fund. 2 to 3 years of living expenses and principal protected liquid assets. This is what you draw from during market downturns. When the market drops, you're not forced to sell at a loss. You live off your reserve and let your investments recover. Bucket 2 is your income bucket. 5 to 7 years of expenses and conservative to balanced investments. This refills your reserve fund during good years and provides stability. Bucket 3 is your growth bucket. Moderate to aggressive growth for investments for long-term appreciation. This stays invested for the long haul and isn't touched during downturns. When the market is up, you refill your reserves from your growth bucket. When the market is down, you live off of your reserves and let everything else recover. This is how you stay invested. Capture the best days and avoid selling low during a downturn. You're not trying to time the market, you're preparing for the market. Same growth potential, less stress, no panic selling. If you want help building a retirement plan that actually protects you from market pullbacks without sacrificing growth, click the link in the description. We'll walk you through your situation, show you where the gaps are, and help you build a plan you can actually trust. And if you found this video helpful, do me a favor, hit the like button and subscribe so you don't miss future videos on retirement planning strategies that actually work. Thanks for watching, and I'll see you in the next one.